Hello and welcome back to the channel. It's Evan Clementino here from C+B. And as promised, we're going to cover another video on job costing. In my previous video, we looked at the higher level side of job costing and how to use my free job profitability tool, downloadable in the description below, to calculate the profitability of whatever job you want. Now today we're going to basically start where we left off. We're going to look at the results of that profitability tool. And we're gonna have a conversation around how to think like a business owner, how to look at those results, and to make decisions on how to improve your results moving forward. Without further ado, let's get to it here. These are the results we came up with from the last job profitability video. I'll just run through quickly how we got there, and then we'll look at the strategic side of things. So step one was to calculate our average monthly overhead. We basically took a profit and loss statement that was broken down by month. So in this example, you had December, January, and February, the monthly profit and loss. And we plugged the numbers into our specific categories. So our total expenses, our total COGS, our total direct labor, the amount of direct labor hours, and the amount of labor hours worked on the specific project that we're looking to calculate. Once we did that, you go to step two, and you can see right here, all those numbers were used to calculate an overhead per direct labor hour. That is, for every direct labor hour that is worked on any specific project, this is how much money in overhead is being spent behind the scenes. And given the fact that this project took 72 hours to complete, we have overhead for this project of $3,400. Then I took the receipts, which you can see here. This is a list of receipts for the specific project. I took these receipts and I plugged them in to the ledger. So all the materials right here, all the subcontractor expenses, labor expenses, and the income that you made from the job, everything listed right here. And that is all summarized in this table below. I'm going to jump to the results here because the same thing is shown over there. You can see that your income, 16 grand, direct expenses, 8.3 grand, overhead, 3.4, and profit is the difference between all those, 4.2 grand. That's shown in the bar graphs here. You have profit of 4.2 grand, and the profit margin, the proportion of the profit relative to the total income generated from the job, is 27%. Now, let's take a look at what these numbers mean and how to compare them to previous jobs or how to make decisions on how to optimize upcoming jobs. The first conversation I want to have is on markup versus margin, okay? So I want you to think about your pricing approach, right? When you price out a job, when you send out an estimate, you say, okay, I'm going to write down all my direct material and direct labor expenses, and I'm going to double it, and that's the price I'm going to deliver to somebody. Well, I'm going to show you how you can use your gross profit to determine whether your pricing method is accurate or not. So here in this job, you have a gross profit of $7,600. That is your revenue, the 16 grand, minus your direct expenses, the 8.3 or whatever it was. Gross profit, 7.6 grand. And what that means as a gross profit margin is 48%. Here, you can see the relationship between margin and markup. If you are marking up your projects at 100%, your margin, your gross profit margin should be 50%. If you're marking your projects up at 50%, your gross margin should be 33%. So when you get your gross profit margin and you see that it's 48%, you need to translate that back into what the real markup would be to derive 48%. And in this example, the markup that you would have delivered on that estimate to derive a margin of 48%, the markup would be 92%. Now, to make that calculation, I would just go to a margin versus markup calculator online, and it'll just spit out the formula for you. Now, for the sake of this example, let's say that this company, when they're pricing a job, they figure out their direct labor, their direct materials, and they times it by 50 or by 100%, right? They double it. That would be a markup of 100% and a gross profit margin of 50%. And you can see that they're slightly under, right? The gross profit margin ended up being 48%. They're pretty close. It's not perfect, but they are pretty close. We'll revisit that in a second and we'll apply to your business. But let's first look at the net profit. So the gross profit is your revenue minus all your direct expenses. To get net profit, we then also subtract the overhead, which we determined 3.4 grand. And the net difference here is your net profit. So 4.2, almost 4.3 grand. Then you can calculate a percentage for that too. Your net profit of 27% is really good. This job was really, really profitable. 27% is a good net profit. Of course, it's going to depend on your business, but for the sake of this example, I'm happy with it. So in that section there, what I want you to take away from it is use your P&L, use your job profitability results, and compare it back to something. To think strategically, you have to know, was I on track with my budget or my estimate? So go back to your estimate, figure out what you anticipated to profit, and then figure out what actually happened and look at the difference. Now, I want you to ask yourself some of these questions. The first one is about just that. Does my actual markup match my intended markup? If it's under, why? If it's over, why? If it's over, it would imply that you anticipated to spend more than you actually did. Hey, making extra money, not a bad thing at all. The only thing I will say is if you're having a hard time selling jobs, this could be why. Perhaps you're overpricing your product or your jobs, and therefore your leads are going with somebody else. If you're consistently if you're consistently under budget or making more money and you're not closing jobs very often, that could be a symptom that you need to lower your prices or at least refine your pricing model. Now, if you're under your intended markup, that means you'd spend more than you anticipated. And in that regard, you're going to need to just look at what happened. What line items? Was it a specific material that put you over? Was there materials that you didn't anticipate to spend and you actually did? Did the project take you longer than it was supposed to? Look at what happened and then keep that in mind when you price your next job. Do I have to worry about that problem again? Next question here is, how much did your overhead erode your profits? So we already looked at the markup versus margin. We determined that the gross profit of this job was more or less what we anticipated. But now let's look at overhead. Because with overhead, that's going to take your gross profits. Your gross profits are going to fund all the overhead expenses that are incurred. And what's left over is what really matters. That's the money that stays in your account at the end of the day. So you want to look at the impact of your overhead on those profits. And you always want to be asking yourself, is my overhead efficient? Do I have an efficient overhead so that I'm not eroding the profits of all my jobs? Can I streamline my costs so that my overhead has the littlest impact on my bottom line? Because with a small, less impactful overhead, you can be more nimble. You can make decisions around your pricing. You can have more flexibility around your pricing to be more competitive, to score more jobs, and to otherwise just bring in more bank at the end of the day to grow. Essentially, what I'm saying, minimizing overheads can maximize your profits, and that's clear as day. The third question here is, am I satisfied with the overhead erosion level? Some businesses might operate with high overhead, but that might come with driving a nice truck, having a nice shop, maybe having multiple assets that aren't fully utilized. If you want to completely maximize the efficiency of your business, then yeah, you're going to want to dial it back, but maybe you're happy with spending some money on overhead because of the benefits that it gives you of having these assets or of whatever else you're getting from the overhead expenses, nicer tools or very high quality indirect labor, like high quality bookkeeping services or administrative services. These qualitative factors will all come into play. So just ask yourself if you're satisfied with your profit margin, your net profit margin, and if you want it to be higher, how can you maximize your overhead to do so? Some examples I wanted to go through here are the overhead expenses that you could cut back without impacting your ability to provide your service. So a truck payment's a good example. If you're paying for an expensive truck, a truck half the price could allow you to do the job just the same. So in that case, you could save half the money of a truck payment, offer the exact same service, and therefore profit more. The next one, could you increase your overhead to unlock larger or more profitable jobs? So again, with the truck example, maybe you can buy another truck that increases your overhead, but that allows you to get a second crew running around, generating maybe twice the revenue or just under twice, like double the revenue, just for the incremental cost of another truck. So that's a little expense that can go a long way in generating a lot more revenue for you. The third one, do I suffer from low profitability despite efficient overhead? That is your overhead costs under control and yet you're still just not profitable? Well, the solution would be to charge more or increase your markup. And you might be thinking, well, I can't raise prices. In that sense, your overhead's already maximized and your target market isn't flexible. Your customers aren't flexible on the price. So you're going to have to consider how to make your projects cheaper. That is maybe cheaper labor or cheaper materials. And if you can't do that, if you can't use cheaper materials or labor, well, then you have a business model that just isn't a very profitable one. You're saying you don't have the flexibility, or you've optimized your overhead. You can't make your expenses, you can't minimize your expenses anymore. You can't charge more to compensate for doing the project. And you can't minimize the direct expenses like labor or material because they might sacrifice the quality or your target market won't pay for it. In that case, your competitors are likely feeling the same struggle, and you may have to consider how to position yourself with new offerings that are more profitable. Or you stick with the reality of a minimally profitable business model. And the last one here is I want you to clarify your goals. So it's okay to look at these ratios as 50% gross profit, 25% net profit, something like that. But you should have your own goals based on the market that you work in, the competitive space that you work in, and what you want out of your business. I'd say in general, this is a commonly expected gross profit for a business of 50% gross profit. That's a 2 times markup or 100% markup. The overhead erosion, so how much your overhead takes out of your business, 35% could be more or less acceptable. Again, it's going to depend on the unique setup that you have. Maybe you can run your business out of your backyard and save on rent. That's huge for overhead savings for a small construction company. That one's going to depend totally on your business. And then your net profit's going to be the difference of the two. So again, at the end of the day, if you're satisfied with the net profit that's coming into your business, or of the future prospect of that, like maybe it's tight now, but in the future, you're setting yourself up to grow with high net profitability. Well, then that's a sustainable business model. And essentially you just need to determine what your ideal ratios are and then align your business decisions to reflect that. And that brings us back to the estimate side of the job costing. In a third video, we'll look at the estimation side of it, right? To like we've covered the relationship between your gross profit margin, and how that relates to your markup. But we can actually bring a tentative or an example project estimate for this project and show you with real numbers how you might tweak the project going forward. The idea is that you have to start somewhere. You have to get this reliable data in your hands so that you can look back. And when you're looking back, you have to have something to look back on. So you look at the previous plan, you look at the budget, or you look at the estimate to determine if you were accurate to some measure that you previously defined. You can, once this process is included in your business over time, and you can calculate the profitability of more jobs. You have a bookkeeper that's determining your job profitability for every job. Well, then you'll be able to unlock immensely valuable trends about the profitability of your jobs. You'll be able to determine which jobs are the most and least profitable based on location, based on materials, based on the sophistication of the project. And you can narrow in your focus on the ones that you want because they maximize growth or they're exactly what you like to do. This is the start of a conversation of job costing in its entirety, and there's a lot of different ways to go about it. But the important aspect is to have reliable data so that you can derive this information, derive these insights. You can have conversations about it, and most importantly, you can make decisions that allow you to make more money, grow your business, and achieve those milestones. Be that another truck, another piece of equipment, another crew, a new shop. I love to see small construction companies grow to achieve their potential. And with these tools, that's what I'm looking to help you with. So download the job profitability tool, follow my last video on how to use it, follow this video on how to think about it once you get those results, and stay tuned for more videos on job profitability, financial statements, and other conversational pieces around the financial success of your construction business. Stay tuned, guys. Like, comment, subscribe, check out my website, clementino.ca, or contact my direct line, and I'm happy to chat anytime about this. Cheers.